Here's something you probably don't want to hear. And honestly, that's exactly why you need to hear it. Every single day, thousands of regular investors are making financial decisions based on myths, not small misunderstandings, not minor miscalculations. Full-blown, recycled, emotionally charged myths that are spreading like wildfire across Reddit threads, X posts, YouTube channels, and comment sections. And these myths aren't just wrong, they are expensive. Not for the hedge funds, not for the banks, for you. For the person watching this right now who actually worked hard to save that money and genuinely wants to protect it. Now, before we go any further, let me be completely upfront with you. I own silver. I want silver to go up. I am not here to tear down the silver market or the people who believe in it. But here's the thing, wanting silver to go up and actually understanding how the silver market works are two very different things. And confusing those two has already cost a lot of ordinary people a lot of real money. My name is Felix Print. I was an actual investment banker, not a guy who read a finance blog and decided to start a YouTube channel. Not a talking head, not a former broker turned influencer. I sat on an actual trading floor where the real decisions were being made, where real money was moving, and where what I saw looked almost nothing like what you're being told online. 6 years ago, I founded the Goat Academy, an education platform where we've now taught over 20,000 students how markets actually work. We don't sell silver, we don't run a coin shop, we have zero financial incentive in telling you whether silver is going up or down. What we do have is something genuinely rare, actual Wall Street mentors, people who spent decades inside institutional banking, portfolio managers, derivative traders, and yes, even metal market makers. The very people the silver community accuses of manipulating the market, I know them. They teach my students. And what they've taught me is that the silver market is one of the most misunderstood markets on the entire planet, and that misunderstanding is not accidental. It is profitable for someone. So let's start pulling it apart, myth by myth. And by the end of this video, you will understand silver better than 99% of the people loudly screaming about it online. Myth number 1 is the one you've probably heard the most. COMEX is almost out of silver, and a default is imminent. The story goes like this. Registered silver at COMEX has collapsed from around 117 million ounces last year down to somewhere below 80 million ounces today. And if the trend continues, in roughly 60 days, there will be nothing left. People share charts. They share countdown clocks. They share stress indicators. And look, some of that data is real, and we track all of it through our own institutional grade tools. But here's what almost nobody explains, and it is the single most important thing you need to understand about this entire argument. COMEX holds two completely different categories of silver. There is registered silver and there is eligible silver, and conflating those two things is either a massive misunderstanding or a deliberate misdirection. Think of it like a parking garage. Registered silver is like the cars in the spots marked for sale. Those are the bars actively available for delivery right now. And yes, that number sits around 70 to 79 million ounces, and it is falling fast. But eligible silver is every other car in the rest of the garage, parked, present, accounted for, just not currently listed for sale. And that number, about 250 million ounces, still sitting in those vaults. So when someone tells you COMEX only has 79 million ounces left and a collapse is 62 days away, they are technically referencing a real number while completely ignoring 250 million ounces sitting right behind it. It's the equivalent of saying a car dealership is nearly out of inventory because the showroom floor only has 5 models on display, while there are 200 more sitting in the lot around back. Those eligible ounces are owned by institutions and investors who can reclassify them as registered with just a few keystrokes. Does the falling registered silver number matter? Absolutely. It tells us that demand for physical delivery is intense. It tells us the system is under genuine stress, and our COMEX stress index reflects that. currently reading 95 out of 100, with paper leverage running at around 7 times and delivery coverage sitting at just 13%. Those are real numbers, and they deserve serious attention. But here is the distinction that will save you from making a very costly mistake. A stressed system and a collapsing system are not the same thing. COMEX has never defaulted, not once in its entire history. Not when the Hunt brothers squeezed it nearly to breaking point in 1980. Not in 2011. Not in 2020. Not in 2021 when the Wall Street silver movement went massively viral and everyone said this was finally the moment. Every single time, COMEX found a way through. Does that mean it always will? No. But if you are betting your savings on a default happening this time, you owe it to yourself to understand the difference between a system under pressure and a system that is actually about to break. Myth number 2 is the one that genuinely frustrates me, because it is so close to being true that it almost hurts, and then someone takes it one step too far and turns a legitimate concern into complete fiction. You've heard the number. 350 paper ounces of silver for every single physical ounce. Futures, contracts, ETFs, options, swaps, all of it stacked up against the physical supply until the whole thing looks like a Ponzi scheme waiting to explode. Now let me show you exactly why that 350 to 1 figure is meaningless, and then give you the real number, which is still high enough to be genuinely concerning without needing any exaggeration at all. The 350 to 1 ratio comes from taking the total notional value of every silver derivative in existence. Futures, contracts, options, swaps, all of it, and dividing it by the physical silver sitting in COMEX vaults. Sounds alarming. It is also, mathematically and practically speaking, a completely useless calculation. Here is why. Imagine you own a house worth $500,000. You have a mortgage on it. You have homeowner's insurance. Your neighbor has a friendly bet about what it will be worth next year. The insurance company has a reinsurance contract on your policy. A hedge fund somewhere has a derivative linked to property values in your neighborhood. Now add up the notional value of all 5 or 6 of those contracts, and suddenly you have maybe $3 million worth of financial instruments tied to one house with one front door. Does that mean your house is leveraged 6 to 1? Does it mean all 6 counterparties are going to show up with moving trucks demanding a piece of your kitchen? Of course not, because most of those contracts never require anyone to take possession of the physical asset. They are financial instruments. They settle in cash. The same is true for silver. The overwhelming majority of futures contracts are closed before delivery ever takes place. Most options expire worthless. Most swaps are settled in dollars. The 350 to 1 number treats every single one of these instruments as though someone intends to show up and demand a physical bar of silver, and that is simply not how any of this works. The real leverage figure, the one that actually reflects genuine delivery risk in the market right now, is closer to 7 times. And you know what? 7 times is still elevated. In a healthy, normal market, you'd expect something closer to 3 or 4 times. So the stress is real, the leverage is real, the concern is legitimate, but it's 7x, not 350x. And the gap between those two numbers is the gap between a credible warning and something designed to make you panic. When someone throws that 350 figure at you, they are either confused about how derivatives work or they are trying to frighten you into buying something from them. In my experience, it tends to be the second one. Myth number 3 is probably the most sophisticated sounding of the bunch, which is exactly what makes it so effective. The argument goes like this. Silver on the Shanghai Gold Exchange trades at a significant premium to Western prices, about 19% higher as of this recording, and therefore Western prices must be artificially suppressed. Fake, manipulated. The real price of silver is the Shanghai price, and everything else is a lie constructed by Western financial institutions. Now this one sounds smart. It cites real data. It references an actual trackable premium that we monitor closely. And it is mostly wrong for reasons that are completely hiding in plain sight. Here is the better analogy. You walk up to a concert venue. Outside at the gas station on the corner, A bottle of water costs $2. Inside the venue, that same bottle costs $8. Is the gas station price fake? Is the venue price the real one? Or is the venue price simply higher because you are surrounded by 50,000 thirsty people in an enclosed space with no easy way out? The Shanghai premium is not revealing the true price of silver. It is revealing that silver is harder to source inside China than it is in the West. And when you understand why, the mystery disappears entirely. China has capital controls. Moving money and metals across the border freely is not something you can just do. Import licenses are tightly restricted. And on top of all of that, China has enormous domestic industrial demand: solar panels, electric vehicles, semiconductors, chips, 5G infrastructure, all manufactured domestically, all consuming silver at scale. So, does a 19% Shanghai premium tell us something important? Absolutely. It tells us Chinese demand is running exceptionally hot. It tells us physical silver is being pulled eastward. It tells us the global market is genuinely tight. But it does not prove that Western prices are entirely fabricated or that they are structurally forced to rise dramatically in the near term. Under normal conditions, that premium would sit at 3 or 4%. When it hits 19, it is an important signal, just not the one most people are interpreting it as. Myth number 4 involves one of the most well-known names in modern finance. And this one doesn't just get the story wrong, it gets it completely backwards. The claim is that Jane Street, one of the most sophisticated trading firms on the planet, holds roughly 20 million shares of SLV, the largest silver ETF, and therefore the smartest money in the world is loading up on silver, betting on an explosive move higher. If Jane Street is in, surely that tells us something. Here's what it actually tells us. And understanding this will genuinely put you ahead of the vast majority of people talking about this topic. Jane Street is a market maker. They do not take directional bets. They do not sit in a room and say, silver is going to $200, let's load up. What they do is make money on the spread, the tiny gap between the price at which they buy and the price at which they sell. If silver is trading at $70, they might buy from you at $69.70 and sell to someone else at $70.10. That 40-cent gap multiplied across thousands of transactions every single day is their entire business model. They are the casino. They are not the gambler. Think of the currency exchange desk at an international airport. They buy your euros at one rate and sell them at another. They don't care whether the euro strengthens or weakens, they just make money on every transaction that flows through them, regardless of direction. When Jane Street holds massive amounts of SLV, they are not doing it because they believe silver is about to explode. They hold those shares because market makers need inventory to be able to function, and critically, for every long position they hold in SLV, they almost certainly have an offsetting short position somewhere else, in silver futures or options. Their net exposure to silver is likely close to zero. What a large Jane Street position actually signals, according to the institutional traders who teach my students, is not direction, it's volume. It means a lot of activity is flowing through this market and that prices may move significantly. But which way? That they are not telling you. Myth number 5 is the one that reveals something genuinely important about how people think about financial systems. And I say this with respect. It reflects a sincere and innocent belief that markets are fair. They are not. And truly internalizing that fact, not as cynicism, but as practical market knowledge, will make you a substantially better investor. The myth is this: COMEX cannot stop a silver squeeze. The system is breaking. There is nothing they can do. But here is COMEX's actual toolbox, drawn from real historical precedent, because they have used every single one of these tools before and they will absolutely use them again. First, they raise margin requirements, sometimes dramatically, sometimes overnight. They did this 5 times in 8 days during 2011. What that means in practice is that anyone holding leveraged silver positions suddenly needs to produce millions of additional dollars in cash by the next morning. Those who can't must sell. Prices crash. It's equivalent to a poker table, changing the minimum bet from $100 to $10,000 mid-hand. Those who can't meet the new requirement are simply out. Second, they can cap how much any single entity is allowed to hold position limits, invented and implemented essentially in real time. Third, and this is the one almost nobody talks about, COMEX contracts contain the right to settle in cash rather than physical metal. Even if every single contract demanded physical delivery simultaneously, which has never happened, COMEX can legally hand over dollars instead of silver bars. Read the fine print. It's in there. Fourth, they can halt trading entirely. Fifth, and most fundamentally, COMEX is not a government institution. It is owned by the CME Group, a publicly traded private company that can change its own rules whenever it determines that the situation demands it. They did exactly that. In the 1980s, when the Hunt brothers cornered the market, they simply changed the rules, and it was completely legal. So when someone tells you that COMEX cannot stop a squeeze, understand that they have stopped every single one that has ever been attempted, using tools that still exist today, and they would implement all of them again before allowing the exchange itself to be destroyed. Myth number 6 is the most seductive one on this entire list, because unlike the others, the underlying thesis is genuinely true. Industrial demand for silver is real, it is growing, and it matters enormously to the long-term price story. Solar panels use silver for conductivity. Electric vehicles use it throughout their electrical systems. 5G towers, AI data centers, medical devices, precision electronics, even defense systems. Silver is embedded in the physical infrastructure of the modern world. And unlike gold, which largely just sits in vaults looking expensive, silver actually gets consumed in manufacturing processes. It gets destroyed. It does not come back. That is a legitimate long-term bullish argument, and I am not disputing it for a second. What I am disputing is the leap from industrial demand is growing to COMEX is going to run out of silver because of solar panels this quarter. These are completely different claims, separated by a significant amount of wishful thinking. The first critical misunderstanding is that major industrial buyers, Toyota, Panasonic, the solar manufacturers, do not source silver by logging into COMEX and buying futures contracts. They have long-term supply agreements with mining companies and refiners. The COMEX price influences those agreements, but it is not the direct mechanism through which industrial demand creates delivery pressure on the exchange. The financial market and the physical supply chain are connected, but they are not the same system. The second issue is substitution. Right now, with silver at $50 an ounce, most industrial users are not spending heavily on finding alternatives. The economics don't justify it. But at $200 an ounce, every R&D department and every major manufacturer gets a very different phone call from the CFO. Copper, aluminum, graphene, carbon, none of them are as good as silver in most applications, but not as good becomes acceptable when the cost differential is large enough. And simultaneously, silver recycling from landfills, old electronics, and decommissioned solar panels becomes economically viable at those price levels, bringing additional supply to market. The industrial demand story is a slow, powerful, multi-decade tailwind. It is not a detonation scheduled for next month, and anyone selling you urgency around it is almost certainly selling you something else alongside it. Myth number 7 brings us to what one of my earliest banking mentors called the 4 most expensive words in the English language. This time is different. Every single time silver has made a significant run, those words have emerged. Every time, people have believed them completely. And every time, the people who acted on them most aggressively have paid for it. In 1980, the Hunt brothers cornered the market. Silver reached $50 an ounce, and everyone said this time was different, until the rules changed, and the price collapsed back to $10. In 2011, unprecedented money printing made everyone certain this time was structurally different. Silver touched $50 again, then fell back to $14 over the following years. In 2021, the Wall Street silver movement went viral. Reddit got involved. And this time it was definitely different. Silver spiked briefly, then traded sideways for years while COMEX absorbed every bit of pressure. And now, in 2026, we have Shanghai premiums, Jane Street's holdings, solar panel demand, de-dollarization, geopolitical instability, and stress readings near historic highs, all of which, we are told, make this time genuinely, undeniably different. And here is where I will be fair to you. Some of those things are genuinely different. The stress numbers are real. The industrial consumption thesis is real. The geopolitical environment is more unstable than it has been in decades. But the specific mechanism, everyone is betting on a forced delivery failure at COMEX, leading to an explosive price. Supernova has been predicted for decades and has never materialized, not once, because the people who operate these systems always find a way to manage the pressure. I know this because I talk to those people. The real question is not whether the fundamentals support higher silver prices over time. I think they do, and I own silver accordingly. The real question is whether it is wise to bet your financial future on one specific catastrophic failure scenario that has a historical success rate of exactly 0. So after dismantling 7 myths, here is what I actually think is most likely to happen, because I am not a silver bear. I am a silver realist, and realists still make money. Institutional analysts think in probability distributions, not narratives. So let me give you mine. A complete COMEX default contracts defaulting, the system breaking, silver instantly jumping to $150 or $200. I put that at 5 to 10%, and honestly closer to the low end of that range. Every tool in the exchange's arsenal exists precisely to prevent this outcome, and they would restructure the entire system before allowing it. A managed squeeze prices rise significantly. Physical markets tighten considerably, but the exchange navigates it through cash settlements and rule adjustments, with silver potentially reaching $80 to $120 before correcting to a new higher range. This, in my view, is the most actionable scenario, and I'd put it somewhere between 30 and 50% probability given the current stress levels. A status quo scenario, silver oscillating between $50 and $80 with gradual appreciation, no dramatic events, nothing worth a dramatic thumbnail, probably 35 to 40%. It's not exciting content, but it's where most sophisticated market participants appear to be positioned. And finally, a deflationary shock, a recession, tightening credit, a risk asset sell-off that drags silver down just as it did in March 2020 when it briefly touched $12, roughly 10 to 15% probability. Low, but absolutely not 0. And if you are entirely concentrated in silver with no hedge and no cash reserve, that scenario does not just hurt you, it potentially ruins you. Institutions manage this by holding physical silver for upside exposure, using options for leverage, keeping cash for dips, and hedging tail risks cheaply. The strategy is not buy silver and pray for a COMEX collapse. The strategy is owning silver as one component of a thoughtful portfolio that accounts for the genuine complexity of how these markets actually function. Is that more complicated than just clicking buy and waiting for the squeeze? Yes. Can you learn it? Absolutely. Does it require being a financial genius? Not even close. But it probably does require someone who has actually sat in those rooms to show you how it works. And that is exactly what I intend to do.